Most of the financial advice we hear, it all follows the same old script, right? Work hard, save your money, pump it into a 401k, pay off your house. And look, that path, it can work, it can build some wealth for sure. But what if there's another way to see the entire financial world? A principle that the wealthiest families and institutions have understood for, well, millennia. It's not some big secret, but it's this fundamental divide that has shaped economies for something like 4,000 years. It all comes down to the relationship between two roles, the creditor and the debtor. And today, we're going to dig into that divide and what it means to deliberately choose which side you're on.
Okay, so to really get our heads around this, let's start with a simple story. It's a great way to see this principle in action. Let's just imagine two brothers. They start from the exact same place, but they choose two completely different paths for building their financial lives. And believe me, their journeys, they reveal pretty much everything we need to know.
So the first brother, he does what most of us are told to do. We'll call him the debtor. His main focus, accumulation. He's all about growing that one big number on a screen, his net worth. So he invests in stocks, mutual funds, all in the hope that they'll appreciate. And of course, he carries what people call good debt, a mortgage, maybe a car loan. Now, his brother, let's call him the creditor, he's playing a completely different game. His focus isn't on just accumulating a bigger number, it's on structure. He wants to own the debt of other people. Think bonds, private loans, things like that. And the result? Well, it's night and day. The debtor's wealth is, well, it's sentimental. It goes up and down with the market's mood swings. But the creditor's wealth? It's contractual. It's a legally binding stream of payments that are owed to him. Big difference.
Okay, now let's put these two approaches to the test. Let's say a big market crash hits. For the debitor, this is an existential crisis. His 401k just plummets, maybe 40%. Equity in his house, poof, gone. And that psychological pain of watching his net worth just shrink day after day, it's just too much. And what does he do? What do so many people do? He sells near the bottom. He locks in those losses. Now, the creditor, his experience is totally different. Now let's be clear, his portfolio value on paper goes down too. Nobody's totally immune. But, and this is the critical part, his income, the actual cash hitting his bank account from his assets, that mostly just keeps on coming. The payments are still contractually owed. So while the debitor is panicking, the creditor sees this not as a crisis, but as a massive opportunity. He takes that steady income and starts buying up the exact assets that the debitor is desperately selling off at bargain bin prices.
So to really understand why this is such a powerful distinction, we have to pull back a little bit and ask a much bigger question. What is money, really? I mean, it's not just paper or numbers on a screen. At its absolute core, it represents something way more valuable and way more finite. You've probably heard Benjamin Franklin's famous line, right? Remember that time is money. But this isn't just some catchy phrase about being productive. It's literally true. The money sitting in your bank account is just a stand-in, a token for the actual hours of your life you traded to get it. It's your past work, your past energy, just stored in a form you can easily exchange. So let's just trace how this works. Step 1, you trade the hours of your life for a paycheck. Simple enough. Step 2, that paycheck is your stored time. Now this is where everything splits. When you take on debt, what you're really doing is placing a claim on your future stored time. A 30-year mortgage, that's a binding contract saying you will trade the next 3 decades of your life's work for a house today. But on the flip side, when you earn interest income as a creditor, that's reclaimed time. That's money coming to you that you didn't have to trade another precious hour of your life for. And that's the real game being played under the surface of all this. It's not just about money changing hands, it's about time changing hands. Getting this really requires what the great investor Howard Marks calls second-level thinking. First-level thinking is what we all hear, right? It's the consensus view. Stocks always go up in the long run. Debt is something to avoid. A big net worth means you're rich. But second-level thinking, that's when you pause and ask the deeper questions. Okay, if stocks are such a sure thing, who's on the other side of that trade selling them to me? Or if debt is so terrible, then why are banks and huge institutions practically desperate to own as much of it as possible? Is about looking past the headlines and trying to understand how the system actually works. So all of this leads to a much better, much more powerful definition of the real goal. Robert Kiyosaki puts it perfectly. He says financial freedom isn't about hitting some magic net worth number. It's about a specific moment in time. It's the moment your monthly cash flow from your assets, that reclaimed time we talked about, is more than your monthly living expenses. That's it. That's the crossover point. That is freedom.
Because from that day on, you no longer have to trade your time for money to live. You can still work, absolutely, but it's a choice, not a prison sentence.
Okay, but to really appreciate the power dynamic we're talking about, we kind of have to look at the history of debt itself, how it went from being this personal thing to this cold financial tool. That transformation is really the key to understanding the whole modern financial world.
So, the anthropologist David Graeber wrote about this extensively. For most of human history, debt was just personal. It was like a favor between neighbors, based on trust and relationships. But then writing came along, and then currency, and suddenly everything changed. Debt wasn't a personal promise anymore. It was a written contract. It was impersonal, you could put a number on it, and, this is the big one, it was transferable. And today? It's evolved into this incredibly complex financial instrument that gets chopped up, bundled together, and sold to strangers all over the world. That journey, from a personal handshake to an abstract security, that's where its modern power comes from. And then there's the whole psychological piece of this, which is just fascinating. The philosopher Friedrich Nietzsche pointed out that in the German language, the word Schuld means two things at once. It means debt, but it also means guilt. And that's not a coincidence. Think about it. That feeling of I owe someone has always been tangled up with a moral feeling, a sense of I've done something wrong. It creates this incredible internal pressure to pay it back no matter what. Our modern system is brilliant at using this psychology. It uses these, let's call them soft control mechanisms. Your credit score, for example. It's not a physical chain, but it absolutely dictates whether you can get a house, a car, sometimes even a job. A mortgage gives you a home, sure, but it also anchors you to one spot, making you think twice about quitting a job you hate. And student loans. People take them on to build a better life, but they can end up controlling your major life decisions for 20 or 30 years. All these things work to lock in a claim on your future and limit your options. So, you see, we keep coming back to the same fundamental pattern. The creditor is building wealth, the debtor is funding it, the creditor is reclaiming their time, and the debtor is trading away their future time. It's so important to get this. Your mortgage, which is a liability on your balance sheet, well, it's a high-performing asset on your bank's balance sheet. It's the exact same contract, just viewed from two different sides. One side is stacking up assets that produce income, the other side is stacking up liabilities that consume time. And the engine that drives this whole transfer of time and wealth? It's compound interest. It's often attributed to Albert Einstein that he called it the eighth wonder of the world. And the quote is perfect. He who understands it earns it. He who doesn't pays it. It's just this relentless, mathematical force, almost like a law of financial gravity, always pulling wealth from one side of the equation to the other. Okay, so a totally fair question to ask right now is, wait a minute, if being the creditor is so much better, why does all the advice we get from the mainstream media push us toward being debtors? Accumulating stocks and using leverage? And the answer isn't some grand conspiracy, it's just systemic incentives. Just think about it for a second. Who makes money when you follow the standard advice? Well, banks make money when you borrow from them, not when you become their competition by lending. Brokerage firms, they make a killing on trading activity, and there's a heck of a lot more trading in the stock market than in the slow and steady world of credit. And the financial media? Come on, their whole business runs on clicks and eyeballs, and nothing gets more attention than a volatile stock market. The boring, predictable compounding of a bond portfolio doesn't sell ads. The system isn't evil, not really. It's just built to encourage the behavior that makes the most money for the biggest players. Now, we have to be intellectually honest here. This isn't a magic bullet. Being a creditor is absolutely not a risk-free path. The best case? Yeah, it's amazing. Stable income that buys back your time. But there's a worst case. Think about 2008. A huge credit crisis where people default left and right. You could lose everything. So the point isn't to find some path with zero risk. That doesn't exist. The whole point is to choose your risks consciously. Are you more comfortable with the risk of the market's mood swings or the risk of someone not paying you back? Knowing which game you're playing, that's what this is all about.
So look, this whole framework, it's not me telling you to go sell all your stocks and buy a bunch of bonds. That's not the point. It's just an invitation to make a deliberate choice about your money, and maybe more importantly, about your time.
Let's look at one final comparison. You've got investor A, who has $1 million net worth. Sounds great, right? But it's almost all tied up in their house and their 401k. Their actual cash flow from those assets is basically zero. So to pay the bills, they have to keep working. They're still trading their time for money. Then you have investor B.
They only have half the net worth, $500,000, but it's structured in a way that generates $45,000 a year in cash, passively. Now, that investor owns their own time.
So, who's actually wealthier? Our whole society is set up to celebrate investor A, the millionaire. But it's investor B who's actually achieved financial freedom. It's investor B who's truly free.
And that brings us right back to the most important question of all. This creditor-debtor game, it's been playing out for thousands of years, and it's going to keep playing out whether you pay attention to it or not. But knowing about it, well, that gives you a choice. So I want you to think about your own financial life. Which side of this equation are you on? And here's the real kicker. Did you choose that side on purpose, or did you just end up there by default? The answer to that question, that just might be the most valuable financial insight you ever have.